I'm Doug MacKenze.
And I'm John Ward.
And we're the co-hosts of the ABCs of IBC podcast.
Come join us as we share our unique perspective on the infinite banking concept as the creator, Nelson Nash, intended.
Welcome.
Hi, everyone.
How you doing, John?
I'm pretty well. How about yourself?
I'm going to be less grammatically correct. I'm good.
Oh,
yeah.
Oh, okay. Well, yeah, I guess I got really well trained in that. Yeah.
No, I'm fine. I'm doing fine.
Fine's fine.
I took some kind of like sick joy out of this. We'll kind of touch on this at the end of the episode, but this was the main reason for me wanting to bring this one up today. Is I saw something funny that came about in terms of a credit rating on the certain treasury of a certain government. And yeah,
the government that you
just a
live
certain
under?
government that shall not be named.
Federal.
A certain federal government that's pretty well known.
Yeah.
So we thought we'd talk today about whether or not whole life companies are secure, because John and I, believe it or not, are in the business of selling policies that are issued by these companies. And, we thought we'd delve into whether or not we are selling our clients a secure holding.
Which, of course, I've talked about. I also own these policies through whole life companies, so I want them to be secure.
Yeah.
Not just for the clients, but obviously for me and my family. So
I'm with you.
Yeah. So
Yeah.
we didn't just take it like, oh, let's just, arm's length. No, this means something to both you and I. Like, that's where we're storing our cash.
Yeah, we would both be unhappy campers if all these companies started like demutualizing and imploding and just, it'd be rough times, right?
Yeah.
But again, not just for our businesses, but also in our personal lives, we would not be happy campers.
Yep.
So,
with that said, we're going to talk about whole life companies, but not every company's the same.
No.
So,
Yeah.
There's a reason why we choose who we choose to work with, because we feel like we understand their thinking from the top down, and that I've seen the numbers and how they stack up against other companies, some of the better known ones. And so, it matters what company. Because,
it does.
Yeah.
Believe it or not, most insurance companies will tell you that they're a really good company to work with. But John and I like to do our due diligence.
Yeah.
We do specifically choose to work with carriers that are exceptionally safe, have a long history, are conservative, and also offer what we think is a superior product. Because, at the end of the day, a whole life insurance product, especially from a mutual insurance company, is going to be, spoiler, a very secure place to park your money. But not all whole life insurance products are the same. I can pretty comfortably make that statement. Some are going to perform much better than others. Some are going to have better structural elements than others. So,
I agree.
Yeah. The other reason for wanting to do this today is because there's an interesting statistic that I wanted to chat about. And that was a very large statistical increase in death benefit claims from 2020 to 2021, around the time that COVID hit place. And so insurance companies were looking at, like I said, a 15% increase in death benefit payouts, which is a lot. A 15% increase is huge. What do you think would happen if most commercial banks, John, had a 15% change in their liabilities?
Well, I think a few of them would close.
Yeah.
and maybe your money would go with it.
Yeah. Well, hopefully it would be covered by FDIC insurance. We were just joking about that before because we don't think very much of FDIC insurance. There's I don't know, I think under $100 million to cover $10 trillion of deposits. So it doesn't do much, right?
No.
But they have, anyways, without going too far in the weeds here, there was a 15% increase in death benefit claims at a time of the lowest interest rates ever seen, I mean, really in modern history. And guess what happened?
They survived.
Nothing happened.
Yeah. Yeah. Business as usual. Right?
Business as usual. All the claims were paid out
Yep.
very quickly. And all these companies declared a dividend in line really with previous years.
Yeah. True
and
enough.
all these policies chugged along as if nothing happened.
Right. Yeah. Because they are conservative risk takers, right? They're in business. They're trying to make a profit, but they've not only have they conservatively invested in individuals for their policies.
Wait, I know what you mean, but can you delve into that a little bit more?
Well, because that's why they ask all the questions. They want to know what your health is. They want to know, do you have the means to keep paying? So they're obviously turning a profit. And mutual insurance companies, life insurance, whole life insurance companies are sharing in that with their policy holders, is part owners. But they do it down to every person that they put a policy on, they're investing in you.
Yeah.
And so they go down to the smallest denominator, and then they look at the big picture, and they also have basically a contingent fund for things when they happen out of the norm, like this increase. But they also have reinsurance, which that means that somebody else is insuring the insurance company, so they're paying part of the cash flow goes to pay for those types of things, so that if things even go further off the rails from what they expect, then they've got a stop loss of their own assets. They don't have to start liquidating stuff because they're in the insurance business, and they've literally insured against their own sort of catastrophic, what would otherwise be catastrophic losses, right? So, I mean, this is why there was no hiccup, right? Because they had themselves protected. They don't overextend. They don't go into debt and bury themselves. No, they don't do that. But banks do that. They overextend themselves to a point that if things shift, then they collapse. We saw that happen just a few months ago it
got covered up very quick.
Yeah, and it's still happening.
Yeah,
right.
They overextend themselves to a point that almost no one's aware of, and if you understand it, it's scary, actually. But yeah, they have funds to cover all known future liabilities. They are experts in statistics and understanding, how people are going to die, when they're going to die, probabilities, all that kind of stuff. And thank you for delving into that more, John, because they are making an investment in you.
Yep.
They're saying, hey, for the ability to collect premiums from you for a long time, we're then going to give you the ability to get a large death benefit later on when you eventually pass. And the idea is that they've done enough with those funds over those decades to exceed the amount that they have to pay you out.
Yep.
Otherwise, they wouldn't be in business.
Exactly.
And so, they use longer term investments. Now I'm going to say, let me back that up. They use longer term vehicles like long term corporate bonds, longer term municipal bonds, longer term treasuries, and all these kinds of things to hedge their bets. And they're not trading bonds. They buy bonds and hold them to maturity. And they are very good at cycling this and understanding how to deal with, they're probably some of the smartest financial people on the planet, truly.
Yeah. I say the wisest investment risk takers there are.
Absolutely.
Right?
As is evidenced by the fact that these companies have been doing this for So, I mean, some of them close to 2 centuries, century and a half. So, but then let's say, and I asked all these questions in the beginning, let's say that an insurance company I can't swear, but SH something the bed, right?
Yeah.
What happens?
Yeah. Well, these insurance companies, for every state that they want to operate in, right, there's a state guarantee association, which they all fund, right? So if you want to do business in any particular state, you've got to put money into this fund that basically, if somebody does get in trouble and needs to be bailed out, they work it out. Somebody takes over with no hiccups, with no sign that this actually happened, other than now you're working with a different insurance company, because they literally already have like a catch basin and a support system that's going to make everybody that's a policyholder whole in the situation. So it can be relatively stealth, right? That you don't even hardly know it, other than you'll get a letter saying that this insurance company's taken over the other insurance company, and everything's the same. Your contract with them is the same, all, and typically that's probably going to be an even stronger insurance company. But they're already prepared that we have a system in place, and it's different than what the banks are doing, with the taxpayers paying for whatever happens, because of this debt stuff and FDIC insurance. What is it? Up to $250,000? Yeah.
Per account.
Yeah, that kind of idea. There's not enough money to cover all of this.
No,
right?
It would be cost prohibitive to try to insure that, really. I mean,
yeah.
But yeah, this is an insular system, and it also works in all of the insurance companies' best interests to not have a situation where death benefit claims don't get paid out, or policies I challenge any of our listeners to go find a situation where a death benefit claim has not been paid out, assuming everything's kosher.
I second that challenge.
Yeah, it doesn't happen. It just doesn't happen.
Exactly.
If there's one thing they're really good at doing, it is paying out death benefit claims.
And I say, if they didn't do that, it wouldn't take very long before that was news, and the whole life industry would fall apart.
Yeah, it would make our jobs pretty difficult.
Well, it would fall apart in almost overnight.
Yeah.
All you have to do is have a few people saying, "Yeah, they reneged on paying the death benefit," and be like, "Okay, well, I guess this product doesn't work.
Yeah.
Or this solution doesn't work." And again, back to doing this for
Dave Ramsey would be all over that.
Well over 100 years. I mean, they've been incredibly consistent that they don't fail in doing what they promised to do.
Yep. Yeah, and I mean, don't get me wrong. There are situations that could suck for policyholders. Like if a company demutualized, that could be a bummer. It may or may not be. Maybe the dividends they're going to pay out aren't going to be the same as they'd pay out before, and things like that. That situation's not very common. And again, you still have that base contract with the base guarantee and the guaranteed death benefit. That's never, ever going away.
Right.
So the worst case scenarios that we can look at here are pretty minimal than worst case scenarios that you might look at with other products and other industries.
Yeah.
Yeah.
Yeah. I want to just touch really briefly on, so the insurance company that Doug and I, work with a lot of our clients with, they're owned by an even bigger firm that does other things in the financial world. But of course, if you went searching on who are the best whole life insurance companies out there, you're going to get some of the, big names that people that aren't even really interested in life insurance probably have heard of because of marketing. And, these ratings, right? Even rating a federal government in their treasury and, who knows, right? We don't know if people are getting paid to look the other way or all this kind of stuff. But the numbers are the numbers if you delve into them. So regardless of the rating, we know that this federal government is in trouble. We're referring to get downgraded. I think it's the lowest we've ever been rated.
It happened once back in like 2008, 2009.
Oh, okay.
Briefly, but it's
short-lived. Okay.
Yeah. So John's, I think it was earlier this week, it was earlier this week. Fitch downgraded the United States
credit rating
because of its, for the next 3 years, because of its excessive outstanding debt, the debt negotiations that played out for a while recently, and it thinks its potential inability to handle liabilities on the books. And like I was saying in the beginning of the episode, it brought me a lot of perverse pleasure to read that, because it's funny. I think, John, sounds like you're going to go through this. Most of these insurance companies now have a better credit rating than what is supposed to be the most powerful financial institution on the planet. And the Fed Janet Yellen was pissed about that, but all you got to do is do a simple check of assets and liabilities. It's ridiculous.
Well, I saw something last night where, since the projections of what the U.S. Treasury needed to cover their liabilities, what kind of cash they were going to need, just since May, what they said they needed in May of this year, 2023, come the end of July, they already said that they were going to need another $245 billion.
Is that a lot of money?
Especially in a matter of 3 months.
Yeah.
It's a lot. And it's like, okay, we thought we needed, $800 billion, but now we need over $1 trillion. And
just a rounding error.
Yeah. And this comes at the same time that Fitch is doing this change or downgrade in rating. And there's a lot of factors. The tax receipts aren't as high as they have been, what they anticipated, and all those things are shifting. I mean, there's a lot of things in the economy. The gasoline usage is down, right? The unemployment, all these numbers where the money's coming from for the Treasury, right? So we know that means, if gasoline just for individuals is down, that means they're struggling a little bit more than they have in the past. There's also commercial numbers are down, so they're struggling a little bit more. So we're down. What I'm saying is that we're tumbling down a hill a little bit. I don't know how steep the hill is, but once you get rolling, it's a lot of work to reverse that. And so
we'd like to not be on the hill.
Yeah, let's not even be on the hill.
That's kind of what we're saying.
Yeah, exactly. So I think that's the trouble. But I wanted to say that, when you look at these ratings, sometimes which I have done, you want to look at the underpinnings of what's really going on with these insurance companies. And so who is really strongest, but maybe not getting rated as high. And I can say I feel very comfortable from looking at, say, the top 4 household name life insurance companies, and how the life insurance company that we work with predominantly, and that they stack up even better. But they have a lower rating right now. So that company is out talking to the people that do the S&P ratings and so forth, and saying, hey, I'm just going to show you the numbers, and you decide what our rating's going to be. But in this case, we know that we're talking about how secure are these companies, and they're secure because they've secured themselves. They are in the protection business, and they're protecting themselves.
It's no different than looking at the security of a household. Like if you have some unknown event like a recession or a depression, people lose their jobs. If you have a household where you have people that are buying cars they can't afford and they have bunch of debt and they're living and all this kind of stuff, and then you have another household of people that save a lot of their income, they live a little bit more modestly, they plan for the future. Who do you think's going to survive that better?
The ones that are planning for hey, there is some things that happen that we may not think are coming. Yeah. But things happen. They do happen.
Just spoiler too, a whole life insurance contract is a great way to prepare for such an unknown thing. And I don't mean to go too off the rails here because we started talking about a certain thing, but I can't help myself, in what you just said, John. If you think, and if you're one of our listeners, and maybe you're right, but I don't think, if you think that with the current level of liabilities that our government has, that they are not going to change the tax code around qualified plans that are supposedly tax sheltered in order to get more money out of them, I think you might be a little naive. Yeah. I think that is one of the largest untapped sources of potential income, and they will go after it as they've done in the past. They can and will change those rules, I believe. Yeah. But I don't know the future. Maybe they won't. But I do think that that's likely. And one of the things that I love about a whole life insurance product, as Nelson talks about, it is outside of the standard tax code. It does not fall under that same classification. It is quite literally classified as personal property. It's very different. And so, at least as of now, with how things have been for a very long time, that is not a concern.
Well, the other thing is, just to emphasize that, is the way it is today. It's outside of their jurisdiction. They have their rules. They make sure it doesn't turn into a modified endowment contract and all that.
They don't want you, paying a $5 million one-time premium. You know what I mean?
Stuffing cash away to hide from paying taxes. But they have their guidelines, and if that life insurance policy is put in place today, we know that those rules are set. They're not going to change the rules on a contract that you have with the life insurance company. Could they change things in the future? Yes.
It is unlikely, though. I just want to,
okay.
Well, they could, right? But they haven't.
Right.
They haven't for
various
for a very long time.
Yeah.
And you could go back and look at the amount of times that they've changed rules around qualified plans and...
Mm-hmm. Oh, yeah. It's almost every year now. It's almost every year,
right?
Yeah.
So they change RMD requirements. They change, when you can take the money out, when you can't take the money out, how much you can put in. Like it's a lot. They've changed these many, many, many times, and they have the right to do it at any point.
Well, I think in terms of people who own homes. Yep. And when the real estate takes a dip in value, right, which happened a few times in my lifetime, but let's just say your house was worth supposedly $400,000, or a house like yours would go for $400,000, and now all of a sudden the market takes a downturn and it's only worth $300,000. That would only fetch $300,000. And then we know that like property taxes are based on a per $1,000 value, right? So they'll say, and of course they break it out for different components, but let's just say it's $20 per 1,000. Well, $20 per 1,000 at $400,000. Hey, they're going to get the tax receipts they need to fund the operation for the town, and so now it's $300. I don't know the exact math, but let's say it's now $24 per 1,000. So they're gonna figure it out, and that's sort of especially with this rating thing happening. They're like, whoa, we don't like that. And you said that Yellen is all upset.
They did not like that.
Yeah, it doesn't like that. And it's like, whoa, wait a second. How do we reverse this? Well, we got to go find the money. And,
Right.
and where is their money? Well, we know there's a ton of money in these qualified plans, including the Ross.
Trillions.
Yeah, including the Ross.
Yeah.
And so it's like, well, how do we get that in and they've already probably figured it out. It's just when will they let it loose?
Well, they're
right.
They're already proposed in the past few years levying taxes against Roth accounts that have over a certain value.
Yeah, exactly.
It's a tax in the sense of it can't exceed that value. So if
Yes.
it does, you need to then withdraw it. And, so again, it's just want to, I know I'll frame this around me. I don't want to be having to think or deal with that.
Yep.
Or at least I want a substantial portion of my foundation to not have to think or deal about that. So,
Yep. And this is a way to do it. And it's much about what we do with the infinite banking concept, but it's also about the power of this whole life policy, negating the idea of infinite banking, just the idea of whole life.
Yeah.
Right. Now, you practice whole life practice infinite banking based off of this whole life is your platform. And why wouldn't you practice the things you can do with these policies? That's really what infinite banking is. What can you do with this? And that's what Nelson explained to everybody.
Yeah.
Like, it's not really anything different than a whole life policy that was structured properly to, reach certain goals. But he put a name on it.
Yeah.
But it's like, look at the benefits, and the benefits.
But
you're
we're
not
saying
subject.
even if you didn't do anything whatsoever with the policy, like you never took a policy loan, which I don't know why you wouldn't do that.
Yeah, seeing you're taking loans from somewhere, probably.
It would still be a very nice product to own.
Yeah, exactly.
For reasons that we talked about. So
I agree.
Yeah.
Awesome. Thanks, Doug.
Is that a wrap?
That's a wrap.
That's a wrap.
Let's do it.
Let's
you guys don't
end
wanna
every episode saying that now.
Really?
Yeah.
All right, everyone.
That's a wrap.
That's a wrap. And really appreciate you listening and all your feedback that you're providing. So thank you for that.
Thanks, everybody. Have a good one. That's a wrap. Bye.
See ya. Thank you for joining us for another episode of the ABCs of IBC.
If you enjoyed listening, please hit subscribe and leave us a 5-star review wherever you listen. It really helps. See you next week.
Bye.